Hello everyone and welcome to the CNBC-TV18's Mumbai Newsroom. I'm Sonal Bhutra and with me as always is Pavitra Parekh and you're watching Mutual Fund Corner. Well Pavitra, you know we always talk about returns, which fund is good, which is not. Yeah. But today let's talk about risks which is associated with mutual fund investing and what do the investors have to look out for, and we'll do a deep dive into just that, into what the several types of risks are and how investors can actually navigate them during different market cycles. So a lot to discuss and a lot to talk about as well.
And such an important topic, right? I mean, I think so often we talk about the fact that if you are not too comfortable, if you're not too educated on the markets, perhaps looking at a mutual fund is better. But that in no way means that this is a risk-free trade that you're making. So let's welcome our guest on the show on that note. Then Kaustubh Belapurkar, who's Director at Fund Research at Morningstar Investment, joins us now. Kaustubh, thank you very much for joining us and taking out the time for this show. And, you know, like Sonal was pointing out, we always talk about possible returns that you can see. We like to highlight past returns. But what is important to note is that there are many risks associated with this type of investment as well. So could you just take us through what you see as the key risks? Because there are several different types depending on what kind of mutual fund you look at.
Absolutely. So firstly, Pavitra, Sonal, thanks for having me. And I think a very pertinent topic to discuss. Like you rightly said, returns often get spoken about, but, risks sometimes can be, kind of push the back seat. And, it's important to talk about them because obviously, we know that mutual funds, extremely well-managed products, but they're by no means, in a short return product, as we all know. They invest in, market-linked securities. So there is going to be an element and, of risk that comes in. Obviously, there's professional money managers who look to mitigate the risk as much as possible. But it's important to understand that, you can't do away with all the risk, right? So there's obviously the overarching risk that you would, buying into any asset class, right? Be it equities, debt, gold, or otherwise, there's going to be that element of the overall market risk that comes in. How's the economy doing? Are there geopolitical issues, and which we've seen in the recent past? And that's those elements will kind of play out and weigh down upon the overall market sentiment and the risk that can come with it. But along with that, there's several other risks that obviously we'll talk about in greater detail as we go along. That investors should be aware of and should evaluate when they're looking to make these investments, right? It could be concentration risk in portfolios. It could be international investing risk that comes in. Could be most people think that fixed income is relatively less riskier. Yes, it is, but there are risk elements associated with fixed income investing. It could be credit risk or interest rate risk. So I think these are elements that investors do definitely need to keep in mind. And I think the one good thing that has happened obviously is that the awareness is increasing, and also by regulations, there's at least some sort of a graphical representation of what they call the riskometer for funds, which gives some sense to an investor when they look at the fund document that, is it less risky or more risky depending upon some of these underlying factors and, where that fund would be investing in. So definitely something that investors should keep in mind and must keep in mind when, they're looking to pick investment opportunities for their portfolios.
Oh, yes. And while we are talking about the types of risks, and as you said, we'll discuss them in greater detail, market risk is definitely the most common one that we talk about in general conversations as well. How big is that risk in the current scenario, and what kind of funds work best in this case, according to you?
Sure. So absolutely. So I think market risk is, it's like that omnipresent sort of risk that exists, and its persistence is there over periods of time. That's because, market is obviously this congregation of investors and obviously sentiments. And, we've seen in the past that, markets do react to, be it economic data, be it, news flows from other regions that come in, and that can impact the price of the security. So even if you have a portfolio, let's take a context of an equity fund, you might have great companies within your portfolio. But, if the general sentiment of the economy is bad, the market's going to correct, right? So that's the market risk, the overarching market risk that comes in, right? And if you think about, and to your question of the more near-term context, obviously, we've seen what's happened in the past couple of years. We've had the COVID crisis, we've come out of that, but then we've had other concerns that have kind of, come out over the last 12 months, right? You've had the inflation that's been persistent globally in India too. while there are signs that maybe some of that is cooling off, but that's not gone away yet, right? I mean, that's probably some time away. There's obviously the war that's playing out, which is playing down on global sentiments, and several other factors that are growth slowing down. So I think all of this is kind of impacting the sentiment of the market, and that's not something that's going to go away in a hurry. So I think market risk, like I said, exists at all points of time. But the beauty of market risk is that, especially in an asset class such as equity, is if you're the right time horizon, and you invest regularly, you can, while you can't do away with it completely, you can definitely lessen the impact of that on your portfolio. So I think that's the important thing that investors need to keep in mind. While in the short term, it might play out, and it has, like in the recent times, but nothing stops you from investing in a great asset class like equities, even though market risk will continue to exist.
Oh, absolutely. If you do have a longer time horizon, then a lot of these could really be minimized so much, and your portfolio doesn't need to take that much of a hit. But Kaustubh, another type of risk that we very casually mention on the channel, we're all guilty of this, is liquidity risk. And for the sake of our viewers, if you could just really explain this, what does it really mean, and then what are the kinds of funds which are really prone to this liquidity risk?
Sure. And I think that's, again, you're right, Pavitra, that this is probably a kind of risk that often necessarily doesn't get spoken about, but I think, again, very important to acknowledge. So liquidity risk could be twofold, right? So one is that liquidity can be at the asset class level that the fund is managing, right? So for instance, you think about the fixed income markets. We know that it is generally liquid when you think about liquidity when it comes to, say, the government securities, select AAA corporates. But as we go down the curve, to the lesser rated, the lower rated corporates, liquidity does, it's not as easily available, so to speak. So I think that, in a sense, is a manifestation of liquidity risk that, if you have portfolios that are exposed to largely, for instance, credit risk funds, they do carry a high element of liquidity risk, because clearly, the papers that they will be holding, they may or may not be able to necessarily trade them at the price that they're quoting, and they could essentially be a discount or a haircut, as we call it, in terms of selling that if they had to sell it in the market, or perhaps they, some certain securities they might not even find ready buyers. So that's the liquidity risk that comes in, say, for instance, on fixed income funds. That doesn't mean that liquidity risks don't exist in equity funds. We obviously have a much more deeper and vibrant equity market across capitalizations. But, for instance, if you have very large size funds, which are trading in the small and micro cap segment with large exposures to, smaller corporates with smaller market caps, if they're to sell a large block of a stock, again, that can come with an additional challenge that, how do you effectively sell that at the price that you want to sell it at, versus, the impact that can come in by selling a large block, because liquidity might be constrained on that particular counter. So I think that's something that investors need to keep in mind from a portfolio construct or from a fund level. There's also the other element that I was kind of alluding to, is that there are certain types of funds which, on a construct level itself are illiquid. So for instance, there are these closed-ended funds that exist, right, both in the equity and the fixed income side. Now, by mandate, they're listed in the exchange. But, if I'm an investor in one of those and I need the money suddenly at some point of time, what options do I have, right? I can try to sell it on the exchange, but liquidity is minimal, or you'll have to pay, I'll have to give it at a significant discount. And that, so I think that's the thing that investors need to keep in mind. One is the types of funds that will traditionally carry slightly higher liquidity risk, but also at a fund construct level. The closed-ended funds can, are fairly illiquid in that sense. So, when you're buying into those funds, make sure that your time horizon matches, the tenure of the fund. So I think these are a few things that you definitely need to keep in mind when you think about liquidity as a risk to your portfolio.
Oh, yes. And you mentioned that low-rated credit will have greater liquidity risk. So let me take that point forward and talk about higher credit risk. In what circumstance will a fund see higher risk when it comes to credit, and which are the funds which are most prone to such kind of risk in current scenario?
Sure. So when you talk about credit risk, right? So what is credit risk? So credit risk is essentially, the possibility of, the issuer of a bond either defaults on their payment or delays their payment, or the principal of the interest payment, right? So that's essentially the credit risk that's coming in. That you thought that the fixed income securities, obviously, the chances of default for the higher rated securities, you go down the curve, the probability of default also increases because they're weaker corporates, right? I mean, they have weaker balance sheets, they're probably over leveraged. They'll obviously, because of that, they'll be lower rated and they'll be borrowing at higher interest rates, right? So now, what happens is two things, right? So if the corporate is in stress, they'll probably delay or default on their payments, and which would then essentially impact the price of the bond. So you either can't sell it, or you have to sell it at a significant discount, or you get nothing back if it's a total default, right? And we have seen instances of that even in the Indian debt market in the past, right? We've seen funds having exposure which had to either take a haircut or write that down. So that's the element of credit risk that comes in. Now, typically when the economy is going through a downturn and it's really bad, then this probably gets a little exacerbated because everyone's kind of struggling to either raise fresh capital or their businesses are not doing so well, so they can't generate the cash to pay back their loans or service their interest payments. That'll become a challenge. But even on an ongoing basis, even if everything's hunky-dory in the economy, obviously the lower rated corporates will be a little more stretched. And that's why they're lower rated corporates, and they will have a higher probability of sort of credit risk attached there, right? Which is obviously displayed in the credit rating of the fund. Obviously, the professional managers look to do a job of kind of balancing that out by doing their own primary research and buying into corporates where they feel there's enough risk reward attached to it. But you can't do away with that credit risk entirely, right? You can minimize it, you can't do away with it. What kind of funds typically have higher credit risk? So obviously that's a category of funds called credit risk funds, which by mandate will hold greater than 65% in AA or below rated instruments. Your lower rated credits there. So obviously these funds will have, but there are also funds within other mandates. So you have to look at the split of the underlying holdings for the fund that you're intending to buy. How much is government securities, AAA, AA, single A, and then, kind of ascertain that, okay, is this fund, kind of subject to higher credit risk or not, if it's going down the ladder on the credit spectrum. So I think that's an exercise that is well worth doing for every investor to make sure that you're buying the fund that matches your risk profile.
Okay, that is a complete explainer on how credit risk can really play out and what you can do to try to minimize it. Kaustubh, thanks a lot for that. We are going to get into a short break now, but I request you to please stay on because we have lots more questions and we're going to continue this discussion with Kaustubh in just a bit. So stay tuned. Hey guys, welcome back. You're still tuned into Mutual Fund Corner and we still have Kaustubh Belapurkar with us to answer all questions related on the risks associated with investing in mutual funds. Kaustubh, all of last year we spoke about interest rate hikes, or of the year before that we spoke about interest rate hikes. So what kind of risk does this really pose to a mutual fund, and how can that really alter returns? And in this case, what would you do, when you are seeing this rate hiking trajectory by the central bank? How do you position yourself in that case?
Sure, absolutely. I think a very valid question because, like you rightly said, we've seen a fair bit of movement in the interest rates upwards. Right? So now, when you think about a bond, you typically tend to think that, look, I'm going to get a certain coupon and get my principal back, right? But that only happens if you hold the bond till maturity. Now, when we think about in the interim, what happens is if interest rates are moving up, there's an inverse relationship with the price of the bond. So if interest rates move up, the bond becomes less attractive because it's paying a lower coupon, and that means the price of the bond will come down. And that's exactly what's happened with the bonds in the past year or so. Now, how do you measure this? There's obviously a number called duration, which gives you the sensitivity of the bond price. But from an investor's perspective, I think the easiest thing to do is SEBI's created these buckets of funds, duration buckets from the shortest end of the curve to the longest end of the curve. And currently, as things stand, obviously we're not at the end of the rate cycle, be it globally or in India. So there is a fair bit of volatility that is expected in the interim on the interest rates, whether it could, kind of move up and down. So the best thing to do is build a core portfolio of, funds on the shorter end of the curve, which are anyways a lot more attractive. They're less susceptible to interest rate risk because the duration of these funds is lower. probably not a good time to get into, your long duration, medium to long duration right now, because, only once we directionally start seeing interest rates, the hike stopping and then them starting to come down will probably be a good time to do that. So I would say that investors are best served by just staying at the short end of the curve right now for their fixed income investments.
Okay, point taken. So out of the ones that we discussed so far, Kaustubh, interest rates, credit risk, we spoke about market risk as well. Which one do you think will pan out the most in 2023, or something that's a long-term risk for investments in general, and how do we mitigate that?
Yeah, absolutely. So I think, two predominant risks. So we spoke about obviously the overarching market risk, given economic slowdown, rising inflation, and the geopolitical tension that's going on. So that's going to be kind of an overarching theme in terms of the risk that's going to be probably playing out in 2023. Along with that, interest rate risk is perhaps another thing which I alluded to in my previous answer, that interest rates are not going to come down in a hurry. They're expected to be volatile. So that's something that investors should keep in mind and probably stay away from the longer end of the curve sort of funds. Now, how do you mitigate these risks? I think salient things that investors should obviously look to do is asset allocate, right? That's the most crucial thing that investors should look to do. Understand their own risk return objectives, their risk tolerance, what is their investing time horizon, which will then eventually kind of dictate what should their asset allocation mix be, across debt, equity, gold, and other sort of asset classes. And they should look to do that. They should look to invest regularly for sure. So, through your SIPs, STPs, definitely build that up. And keep reviewing your portfolio, because at any time if an asset class gets heated and it becomes over allocated in your portfolio, depending on your asset allocation, you have to bring that down, because that's what prudent asset allocation is. And I think investors are best served by doing that. So I think if they keep these three simple rules in mind and forget about looking at which fund has done well over the last few years or which asset class has done well, if they cut that noise out, they'll mitigate a lot of these risks, reduce them to a large extent in their portfolios.
All right, that is very useful on how it could really look going forward. Kaustubh, what do you think of the STP or SIP route, and do you think that in a situation where you expect heightened market risk, this is perhaps a good way to do it, because you could, at least you're getting like an average rate, right?
Yeah, absolutely. So one is that it removes the element of market timing. And more importantly, secondly, what it does is, the behavioral bias, right? That otherwise I'm sitting on the sidelines wondering, is the market going to correct more? Should I wait? And you probably end up missing the ride. So I think that's the important hack, the behavioral hack that an SIP creates, that it just puts it into autopilot. So one, obviously, like I said, it mitigates the timing risk altogether. You're just averaging your investments out over a period of time, and you're not making any rash decisions because you've already put that in an autopilot mode.
Okay, all right, Kaustubh, it was an interesting conversation. Thank you so much for highlighting all the risks that are associated to mutual fund investments, and most importantly, how one can actually go ahead and mitigate them as well. Thanks a lot for joining us here on Mutual Fund Corner. And with that, it's a wrap on this edition of the show. Stay tuned for Closing Bell to take you through the last hour of trade. And thanks for joining us today here on CNBC-TV18.